Let's be real for a second. Does investing ever feel way too complicated? It's this world of crazy jargon, confusing charts, and so-called gurus that just leaves you feeling lost? Well, what if I told you that one of the most powerful ways to build real wealth is actually incredibly simple? Today, we're going to break down the Boglehead philosophy. It's a straightforward, no-nonsense approach to investing that's designed to put you on the path to financial freedom. All right, let's get into it.
And look, don't just take my word for it. This is a direct quote from Warren Buffett, arguably the most successful investor of all time. When the Oracle of Omaha himself says that a simple, cheap index fund is the best way to go for most people, well, you gotta pay attention. This idea right here is the bedrock for everything we're about to talk about.
So here's our roadmap for today. First, we'll get into the investor's dilemma. Then, we'll uncover John Bogle's radical solution. After that, we'll get practical and build the three-fund portfolio. And then talk about mastering your own mindset, which is crucial. We'll see how this whole thing works for a lifetime, and finally put it all together to find your path to freedom. Okay, first up, the investor's dilemma. This is all about a fundamental trap that, honestly, keeps millions of people from ever really getting ahead financially.
And this right here, this is the core of the problem, the time/money trap. We're taught from a young age to think like employees. We trade our hours for a paycheck. And if we want more money, the logic goes, we have to work more hours. The problem is, that's a treadmill. You're just running in place, earning to spend, but never building the kind of wealth that gives you both your time and your money back.
Now, this trap gets even worse when people actually try to invest. The hard truth is, most investors, and I mean even the professionals, fail to beat the market. And why is that? Well, it's because they fall for these classic mistakes. They try to guess when to jump in and out of the market, which is basically impossible. They try to find the next superstar stock. They pay these massive fees to fund managers who promise the moon but rarely deliver. They panic and sell when the market crashes, or they buy into a frenzy at the very peak out of FOMO. It's just a recipe for disaster. And if you still think you can just pick the winning stocks, just look at this number. Over a period of nearly a century, just 4% of all U.S. stocks were responsible for all the gains above what you'd get from super safe government bills. Let that sink in. The overwhelming majority of companies basically go nowhere. The odds of you picking winners out of that tiny 4% consistently, they're just not in your favor. So, if trying to outsmart the market is a loser's game, what's the alternative? Well, this brings us to the beautifully simple and, at the time, totally radical idea from the founder of Vanguard, John C. Bogle. This quote just nails it. It's the entire philosophy in one sentence. Why would you waste all your time, your energy, and your money trying to find that one magic stock, the needle, in this massive haystack of thousands of companies? Bogle's genius was to say, stop looking. Just buy the whole haystack. Own a tiny piece of every company, and you are guaranteed to own all the winners without ever having to guess who they are. And here's the official term for it: passive index investing. It is the exact opposite of what you see on TV. You're not trying to be a genius. You are simply saying, I'll take the market's return, thank you very much, by owning everything through a low-cost index fund. And the funny thing is, by doing this, by aiming to just match the market, you minimize fees, you lower your stress, and you actually end up outperforming most of the active investors who are trying so hard to beat you. Okay, the theory sounds great, right? But how do you actually put it into action? Well, that's where the famous Boglehead three-fund portfolio comes in. This is your simple, practical blueprint. And here's what it can look like. This is a really common starting point. It's built on just three simple pillars. You've got 60% in the total U.S. stock market to capture domestic growth, 20% in international stocks for that global diversification, and 20% in U.S. bonds for stability. I mean, think about it. With just three funds, you're more diversified than someone who owns like 50 different individual stocks. Let's break down what each of these does. Your total U.S. stock fund. That's your engine for growth. It gives you a piece of thousands of American companies. Then you have the total international stock fund. This is so important. It protects you from having all your eggs in one basket. The U.S. won't outperform forever, you know? And finally, you have the total U.S. bond fund. This is your anchor. Bonds are the brakes on your car. When stocks get crazy and go down, bonds tend to hold steady or even go up. It's what helps you sleep at night. So how do you actually start? It really is this simple. 4 steps. First, figure out your allocation, your mix of stocks and bonds. If you're younger, you might want more stocks. Closer to retirement, probably more bonds. Second, pick your low-cost funds, like the ones we just mentioned. Third, and this is maybe the most important part, automate everything.
Set up automatic investments from your paychecks so you're not even thinking about it. And last, just check in once a year to rebalance to get your portfolio back to its original targets. That is it. Seriously.
Okay, we have covered the what and the how, but this next part, this is everything. You can have the most perfect, low-cost portfolio in the world, but it's worthless if you can't control your own behavior. Your mindset is your single greatest asset. And this is why that mindset matters so much. Imagine a huge market crash. The person who is 100% in stocks sees their portfolio just get crushed. It's terrifying, right? But the Boglehead with, say, an 80-20 mix of stocks and bonds sees a much smaller dip. That bond part of the portfolio acts like a shock absorber, and that isn't just a financial buffer, it's a psychological one. It's what gives you the courage to stay put and not sell everything at the absolute worst possible moment. To really win this game, you have to live by these tenets. It's like a code of conduct. You make a simple plan you can actually stick to. You invest on a regular schedule, whether the market is up or down. You find a risk level you can stomach. You just refuse to play the market timing game. You use index funds. You keep costs and taxes as low as humanly possible. And above all, you keep it simple. Discipline, not brilliance, is what builds wealth over the long haul. So far, we've pretty much been talking about the accumulation phase, the years you're working and building your wealth. But what happens when the paychecks stop and you need that money to live on? Let's talk about how this strategy works for your entire life.
This is the big question, isn't it? It's the one that keeps a lot of retirees up at night. Because the whole game changes when you flip the switch from saving to spending. Suddenly, a market drop isn't a buying opportunity anymore. It's a direct threat to your income. A big crash right when you retire can be absolutely devastating.
And that threat actually has a name: sequence of return risk. It sounds complicated, but it's a simple, scary idea. If the market tanks right after you retire, you're forced to sell way more of your investments at rock bottom prices just to pay your bills. This can permanently cripple your portfolio's ability to recover, and you could run out of money way sooner than you planned. So, how do you fight this risk? A really popular and practical method is called the bucket strategy. Just think of your money in 3 different buckets based on when you need it. Bucket number 1 is for right now, 1 to 2 years of living expenses in super safe cash. Bucket 2 is your safety net, another 3 to 6 years of expenses in stable bonds. And bucket 3? That's your growth engine. It's the rest of your portfolio invested for the long term. If the market crashes, you just live off buckets 1 and 2, giving your stocks plenty of time to recover. It's a really smart, simple solution. And that brings us to the end. We've gone from the problem to the philosophy to the practical steps for your entire life. So let's just tie it all together and talk about what this really means for you, your path to freedom. We're back to another quote from John Bogle, and really, this is the whole point. The financial industry loves complexity because complexity is profitable for them. Bogle's great gift to all of us was showing that the exact opposite is true. Simplicity isn't settling for less. It is the most powerful weapon you have. So if you take away just one thing from all this, let it be this. You don't achieve financial freedom through genius stock picks or complicated strategies. You achieve it through simplicity and discipline. It's about your own behavior, not how smart you are. The only question left is, are you ready to just get out of your own way and start? Hey, if this explainer helped clear things up for you on your financial journey, do me a favor and hit that like and subscribe button, and maybe share it with a friend or family member who you think is ready to take control of their future. Thanks so much for watching.